Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world.
Hey, nice. Thanks for having me, Greg. My name is Jed. I'm based in Singapore, former tech operator. The last startup was actually backed by Andreessen Horowitz, built the world's largest API marketplace. From there, turned venture investor as an angel, which, if you think about it, is kind of a silly way of learning venture by risking your own money when you don't know what you're doing. In spite of that, and bumbling through, I've done okay, have got an exit. I've backed 2 companies at seed stage that have turned unicorn. One might IPO this year. Let's see, fingers crossed. And then I went down the path of building my own angel network to do what's called syndicated deals. So today, my investor network is 1,400 investors around the world. We've written as large as $1 million checks, and we're still continuing to grow. And the last thing of what I do is angelschool.vc. It's effectively my education business. And we have a mission to help demystify the world of venture capital, to help more investors who want to learn this to do it in a safe way. So that's what I do.
Nice, great introduction. Thank you. And it's so great to have you on the show. We've been waiting a while, haven't we? So it's good to finally get you on and hear about all the stuff you've done. So look, I think the best obvious place to start is tell us about what led to all of this. If we kind of rewind the clock a little bit, I'm really curious to know about what led to your initial startup. So even before the startup, sort of what led to that? What was I always like to ask people what the light bulb moment was. Do you know what I mean? Because I think that's really interesting, because there's usually quite a few, isn't there? It's not usually like, this is my idea and I'm going to stick with this idea until I exit. It changes, right? So tell me a bit about that. What was it, and then what led to it?
Yeah, I think subconsciously I'm a bit of a rule breaker and a rebel. As somebody who grew up in Singapore, I kind of describe myself as a very bad Singaporean. And that usually triggers the question, well, what does that actually mean? And,
what is a good Singaporean? I guess that's the question, isn't it?
Well, I'll tell you what a bad one is. I know that very well. What made me bad is I can't follow rules. I don't like being told what to do, and I was bad at school. So that's like the holy trinity of like being bad in Singapore. And I think it's a lot of like my nature, right? I just look at things unconventionally, and I look for different paths to success.
That sounds very, very close to my heart. I must admit. Yeah,
we must have found each other on the internet. There's this common thread, right? It wasn't by sheer coincidence.
Exactly.
So I mean, even in my corporate career, right? I did my MBA, which is a very traditional thing to do. Did the corporate path, and I just kept seeking out roles, honestly, subconsciously, they just move towards like more innovation, just earlier stage where the rule book isn't written. And I think fundamentally, the way you win in whatever field that you pick in life, right? Whatever that might be, there's 2 paths to it. One is you can just be really, really excellent at your field, right? It's like trying to win the 100-yard dash at the Olympics, or you can approach things differently. And I'm the latter group. Right? I kind of describe myself as honestly being pretty mediocre in most things, but so I've got to get a little creative with problem solving. And so in the same way, when building companies, I look at market opportunities that are untapped, that are unintuitive, right? So that applied to the API marketplace business, of which I was an early team member. And also, if you think about what I'm doing today at Angel School, the same thread holds.
In what sense the thread holds?
Yeah. I'm looking at ways of, okay, what's a really big market?
Right.
And why is this something that is untapped? And why does this particular play, this strategy, why is it going to win?
Right. So there's something holding it back to some degree currently. What can kind of crack something open there in a way?
Correct.
Right. Okay.
So I'll double click a little bit of detail in both of these businesses, right?
Yeah.
They're very, very different businesses, but there is a common thematic. The idea with the API marketplace, think of it as an app store for API services. And it's just for software developers. They'll go find an API to build applications from, right? The problem that we're solving is that Without this, without some sort of aggregation, they've got to go hunt around the internet literally and go find all of these different services, test them out in separate portals, in sandboxes, all of these things. And it's a pain in the ass. And so by finding all of these services and aggregating under one portal and building tooling around it, they can access them a little bit more seamlessly. It's more than that, though. If you think about any multi-sided business, right? There's a buyer and a seller persona. This is the only marketplace business I can really think of where the buyer and seller persona are the same. Right? So most marketplace businesses, that's the hard part about getting it going. It's that flywheel, right? You've got to build supply and demand at the same time. But what if you've got this business where, the buyers of APIs are also the providers of APIs? It's the same person, which makes growing this a lot more easy. Plus, if a developer is using a service through the platform and it's embedded in the code, it's one of these things that's super sticky. And as they grow usage, you kind of scale alongside your customers, right? So that was like the dynamic that I saw, right? And there was nobody doing this really at scale, right? There was some plays that were very verticalized, right? We've got a certain subset of APIs. I don't think it works, right? Because you solve a particular set of problems, but this has to be a horizontal play, right? It's just got to be like just a really broad set of services. That's how you win the market. Now, kind of shifting. Sorry, can I shift gears?
I was just going to really quickly say it's really interesting. I never thought about that with the API market, but it kind of reminds me of very tangentially, like not exactly, sort of hobbyist markets where where you've got a marketplace where usually the sellers are within that hobby and so are the buyers, and it's very much a circular market. So while there might be a lot of categories within it, it's kind of the interest is shared. Everyone's a customer, everyone's a provider. It's a similar kind of
correct
concept,
so I agree. So it's either the same persona or there's a subculture that holds everyone,
right.
Another example we see in the market might be we've seen these are you familiar with like home construction DIY and things like that? These sorts of markets, right?
Yeah, a little
like
too much.
Okay.
Spend too much money on that.
It's a little bit of a culture, right? Like go look at Home Depot, right? And people go hang out there and they want to talk about lumber and nails and whatever else, right? And just all nerding out, right? But
I'm not quite at that level, but
right. You get the point.
Yeah, absolutely. Yeah. Subcultures have this intrinsically built into them. There's always markets within them.
Yeah, for sure. Exactly.
But sorry, you were going to say you wanted to switch gears.
Oh yeah, I was going to switch gears and talk about what I do at Angel School today, right? Which is my education business. We teach programs. We effectively help people who are interested in the world of venture capital enter the world safely, right? With really good world-class knowledge and just no BS, just real talk. And I firmly believe in that. What I'm known for, my flagship is building angel networks and syndicates. It's a very interesting spot to be in that in the world of venture education, nobody teaches this. Literally, nobody teaches what it is to build an angel network or a syndicate. These things do exist out in the world, but I think that the execution fundamentally is very, very rudimentary. It's just very nascent and everybody's taking swing of it, doing the best that they can. But I think it's very imprecise. And I've built this whole playbook based on my own experience. And believe me, Greg, I am very, very good at this. To put what that means in numbers is my investor network that I built, right? It's 1,400 today. It's enabled me to write $1 million checks without a VC fund. We know how to harness the growth mechanics of doing this such that today my investor acquisition is completely inbound. So new investors come seeking out our deal flow. So I no longer go out and find investors. So that's the scale of it. The other part of it is the efficiency. Efficiency for me means that I spend a princely sum of $60 a month today on my tech stack to manage this community. And I have no team. Right? And so it's both of these things in combination that makes us good. And this is exactly what I teach. Why I think it's an interesting market opportunity is that if you look at the world of venture education, like I said, nobody does this. And yet somehow syndicates and angel networks, right? By my estimate, finger in the air, we're talking about moving maybe about $10 billion of capital a year. So have we found an underserved market segment that somehow deploys $10 billion a year? If that is the case, is there a market? My bet is yes. Then the question becomes the timing, and am I the right person to solve it, right? How are we going about it the right way? Right. So this is what we play for.
Yeah, I think you're absolutely obviously spot on, and you know that. But it's something like there seems to be quite a lot of these fairly, what's the word, legacy sort of components within venture. I mean, just the topic that's come up recently quite a lot on this show with investors is about the legacy nature of the way that due diligence is performed, for example, within venture, and how, you know, it's one of the largest asset classes in the world, and yet the due diligence level, the quality of data, the process not being standardized and not being scrutinized in the way that it is for any other asset class is simply mind-boggling. And it just goes to show that there is something I think I don't think it's too controversial to say there is something fundamentally broken within venture when it comes to especially the investment side of it and being treated as an asset class. And so it's ripe for some form of restructuring and some forms of innovation for sure. Yeah. But it's mighty impressive that you've got a network that large. You're able to deploy checks of that size and no team, barely any overheads. That's incredible to be able to function in that sort of lean efficient way. And I suppose also you're not burdened by all of the constraints that perhaps come with a venture capital firm when it comes to sort of the red tape that's involved there too, the bureaucracy, and I suppose even from the deal flow perspective too, what it means for the startups themselves, because quite often there's a lot of complaints that founders are sending in a deck and an associate who's straight out of college is looking through it, passing it on to another associate to look at the numbers who's just come out of college, and then it's like, it goes through like all these people, and then it maybe gets to someone that's had an exit and knows anything about startups, right? Whereas I'm assuming within your network, you're talking about people who have a pretty decent grasp or handle on that landscape from the off.
Yeah. So there's a few things that we touched on here, right? One is kind of how venture, you could describe it as broken. I tend to agree, just because it's this innovative, exciting, up-and-coming space, it does attract a lot of attention, and not always for the good reasons, right? I think that venture capital, honestly, in a lot of cases, could stand some growing up, right? And investors need to get a little bit more sophisticated and almost take a page from private equity, right? Just those fundamental skills do matter a lot.
Hi, a friendly reminder to share this episode with your network, like, and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
And so there's this tension, right? How do you keep that innovative spirit, keep the disruptors, the people who want to take crazy swings and build something and back something different into this without taking all the spirit and soul out of it? I don't know the answer, right? But I think it's a philosophical question that always will exist. I do think the pendulum swung a little bit too far into just anybody with a pocket full of dreams can take a swing at it, right? It maybe shouldn't be the case. Yeah, I mean the way we are approaching due diligence and being better at that is actually through the combination of network and our programs. Right? There's this saying in venture where people always say it's all about deal flow, or somebody has quality deal flow. I reject that categorically as an axiom, because I found that when people say, oh, somebody has quality deal flow, they're usually referring to signaling value. They're latching on to something and say, hey, this company has an outsized probability of success, and some of these things become like, this company went through Y Combinator, or the founder had a previous exit. Or they are venture backed even. And I'm not saying each of these things don't have any value. I'm just saying that they're vastly overvalued, The real art and skill of figuring out whether a company is good or not comes down to the whole due diligence process, in my view. And so if you want to do good due diligence, it's an awfully heavy lift, frankly, right? It's both human capital, and there's a lot of human capital constraints. It's literally people and time. It's access to expertise, and all of these things, right? It's not a technology problem. Sure, there's some tooling, there's some automation, things that could make your life a little easier, but it's fundamentally human capital. This is the state of the art. This is why I think, when companies do come with some automated AI due diligence thing, I'm personally very, very skeptical, right? You don't find alpha, you don't find winners if everything is just a model on what success is predicated on from before. It's a human problem. And so the way we want to solve that is we have our programs. And what that does is it gives every of the investors in our network a common grounding for how to do due diligence, because otherwise, there is no common definition and everybody's approaching it a different way, and it's a hot mess. Now, what happens after the program is we invite the investors to join our investment committee. Right? So we give them a forum to be part of these deals, get engaged, work on due diligence. And here we're getting the opportunity to tap into their individual expertise. Right? So it's this combination of the education, which is a common framework for looking at how we look at deals, and then that engagement layer where we bring together people, right? And we can tap into that expertise, and there's this trusted relationship among all of us. I think this is what moves the needle. It's distinct from a VC fund or any sort of fund, really, because there is a fixed pool. Think about a fund with $100 million AUM. It sounds like a lot of money, but really we're talking about 5 full-time employees. There's one person that's an administrator. The 2 partners are spending half their time fundraising or, taking LPs from the ledge. And you've got a couple of associates trying to get through all of this due diligence, right? And how much do they know? I'm sure they're very smart, but I'm just saying there's a severe bandwidth and expertise constraint.
Yeah. So within your network, when it comes to, so you said the deal flow is mostly inbound now, but then how does it work with the sort of deeper dive due diligence process when someone's interested? Is there kind of a trusted enough process that if, say, someone sees that there's been a commitment from Joe Bloggs over there, John Smith over there, that actually it's like, okay, I think I have a certain level of trust to maybe skip some of the finer detail I would, because part of the syndicate's already started to make moves. Do you know what I mean? Or is everyone individually who wants to invest going through that same level of rigor?
Yeah. Frankly, it's a work in progress.
Okay.
Right? We do think about governance, creating the right creative tensions in this process to optimize for this. So I'll kind of talk through some of this detail, right? Firstly, we get deal flow, and it's a never-ending process. We're just scouring any deal flow that we can get and to put it into the system. The investment committee is where we start sifting through the deals and progressing through diligence. In the end, on a given year, I might do 6 or 8 deals. That's it. But what we want to do is to cram through as many deals as possible, right? Thousands. But in the end, only arrive at 6 or 8 picks, because then, by definition, the quality should go up. Now, when the deals come in, we talk through all of them at the investment committee and we form deal teams. So, we compartmentalize it. It's not like 11 kids on a field chasing one ball, right? It's 2 or 3 people work on that deal, 2 or 3 people go on that deal. And we just let them go, because you also don't want people all working on the same deal, because, it taints the pool. Right? They get too invested individually. So you want to compartmentalize. So they individually run off as independent cells, do the diligence, come back. Usually I'm coaching in the background, right? Say, go do this. Are you on the right track? And they come back to the investment committee and report up.
And is that just based on whoever puts their hands up and says,
basically,
this is really interesting to me. I can see myself kind of taking lead on,
correct,
deep diving
correct.
into this. Okay.
Yeah. The common lever is that people will raise their hands and do it when they know something about the company. So that's a natural part of human psychology that we tap into, right? Just as an example, I'm looking at a company now that is in canine oncology. Basically, they are out to cure dog cancer. I'm not a biotech person. I'm terrible at the sciences. It's just, what do I know? I have absolutely no standing to assess a deal like this. So how do you solve that problem? Right? You could just say, no, drop it. It's not our deal. But through this investment committee structure, I actually had somebody who worked for GSK doing oncology commercialization. I had somebody else who has a PhD, studied animal to human translational medicine. And it's a completely random thing. We didn't engineer the team this way because you don't know what the deals are coming down, right? And so building the network is about just building a randomized expert network. Diverse, we want that, we like that, because you never know what the deal is going to look like. But when somebody sees something that they know, they are far more likely to raise their hands. And so we tap in not just the bandwidth, but also their specific expertise. The other part, Greg, is that we parallel path multiple deals at the same time. Meanwhile, I will only ever float one deal to my investors at any one time. So we've architected this system that injects tension for all the deal teams, right? The 2 or 3 people that are working on one deal, they're effectively competing against all the other teams for that very one slot. And it makes them rise and push themselves. Like, if I want this deal to pass, I'm going to work more and to put together the best possible diligence and package, because they've got to convince everybody else, not everybody else, but we ask for a quorum in order to pass the deal. So there's a lot of these structures in place in the background. We're always experimenting with it. And I dare say it's not what people typically expect of an angel network, right? They think, we'll just float it out and whatever sticks.
Well, I mean, I think that makes sense if you're talking about 20, 50 investors in a group. But once you're at the size, the scale that you're talking about, there has to be a more structured way of approaching it. Otherwise, it would just be absolute chaos, and you wouldn't get any form of valuable engagement from anyone. Do you know what I mean? So I think that makes sense for your scale, absolutely, to take that sort of process. But do you find that, or do you suspect, maybe, because maybe it's not necessarily clear, that there may be a sort of negative side effect potentially to that competitive nature, where it sort of pushes in and bleeds into the way the interactions occur with the founders then? So, because if these investors are, like you say, sort of really pushing themselves to try and dig as deep as possible into these startups, find whatever it is that's really going to sort of convince you to to choose them, that they might be then themselves sort of transferring that competitiveness, that tension then onto the founders to sort of push for that information themselves. Does that make sense?
Yeah, it makes sense. It's an interesting question. It's not something that I've observed.
Okay.
I do take a lot of care in the culture that we're creating, right? So think about it. The setting that we're working on in the context in these investment committees is that everybody is there out of passion, right? They're a volunteer. They don't work for me. I don't pay a salary. And so they owe nothing to me. It's almost a pretty social setting. And so if somebody is working on something and they make a mistake, the North Star for us is making great decisions, which means that we have to confront mistakes. We can't softball it. So how do you do that, right? In the interest of, just intellectual purity, and also as a service to all the other investors, that it's a learning exercise to be able to tell them that they're wrong without turning it into a negative, traumatic thing. So I don't know. I mean, I hope that we're building the right culture. I feel like we're on the right track. And when we work with founders, it isn't doing necessarily due diligence to the nth degree. It's also getting what information that we need, and to be able to make, we want to make an investment argument that we can stand behind. The deal might not work out, but at the end of the day, I want to say, hey, you know what, the thesis, we might have made a mistake. There was something that happened that as a result, it didn't work out, but still, we stand by the thesis, right? The research was as good as we could have made it.
Yeah, fair enough. So before we carry on this thread, I do want to quickly go back in time a little bit, because I'm curious about your exit. That led to all of this, just really briefly, if that's okay, because I think these exit stories are for the audience, especially quite interesting. We've had quite a few on the show now, and they are interesting. Everyone's experience of an exit is slightly different. Everyone's capability to talk about it is different too, depending on the NDA they're under and so on. Too. But would you better kind of explain a bit about that? Like, what led to the exit? Was it strategic? Was it kind of out of nowhere? And what was your experience of that whole process?
Yeah.
Rev Ops leaders, let's be real. You can't optimize what you can't measure. You've got the dashboards, the pipeline data, the forecasts, but what about your sales team's actual skills? That's where Peer, today's sponsor and my startup shamelessly, comes in. Peer runs remote, expert-led sales skills audits. Think of it like a MOT for your revenue team. Instead of guessing who needs coaching or relying on lagging performance data, Peer proactively identifies strengths, skill gaps, and hidden risks before they impact revenue. The best RevOps teams run these audits regularly, creating a structured AI-ready data set that powers smarter hiring, sharper enablement, and faster revenue growth. The best part? You can get started with a free discovery audit plus 20% off your first full audit today. Just click the link in the show notes or use the QR code on screen, and you can start making data-driven sales decisions today. Now, back to the episode.
So, I mean, candidly, there is a limited amount of stuff I can share, right? Just like legal reasons and things like that. I mean, I was with the early team all the way up to like kind of Series B, and frankly, like stepped away after that to focus on other things and shift gears towards being an investor, while the team scaled up after raising capital from, I think they took money from M12, so this is Microsoft venture arm. They were planning to they wanted an IPO exit. There was this period where they were trying to crack the enterprise, but in the end, I don't think we were all that successful in doing that. It came down to a combination of like the sales hires and market timing had to play an effect in that. But in the end, the company did get an exit through an acquisition, a trade sale. I don't think it was the exit that everyone dreamed of, but it's a decent enough outcome if you're early enough in the game.
Fair enough. Yeah, I mean, what is your takeaway when it comes to IPO? Because I'm reading a lot online at the moment. I'm not really plugged into it, so I can't comment too much. But from what people are telling me in my network and so on, that this is something that's becoming increasingly rarer and rarer, and even the hoops that you're asked to jump through now are becoming insane. Like, do you know much about that side of things, and do you have any opinions on it?
Yeah, look, let's start with first principles, right? We look at companies and we're always going, can they be big enough? Is the market big enough? Can the play be big enough for them to get to an IPO? Why? If you build it for an IPO, you might have a fighting chance to get to a trade sale. Right. So that's kind of the lens that we look at it. The market, the solution, and do the founders want to get that big? What is their intent? Right. Because that's the variable that stays in the equation. I mean, interestingly, when we look at the data around IPOs versus M&As, actually it turns out that M&As tend to have more favorable multiple exits for investors. I think there's a few dynamics to unplug, right? The picture isn't clear. One is that the last few years, IPO exits have become rarer because we're just in a weird time with venture, right? In the funding winter. IPOs also have this weird 6-month lockup for investors after it goes public. You can't sell. And then what happens after 6 months? How does the stock do? That's an unknown variable. I think in more recent years, another thing that has been in play is these reverse mergers or SPACs, the special purpose acquisition vehicles. Basically, it's going public without the help of investment bankers. Right? The thesis is that, hey, it's expensive. Fundamentally, that's the argument.
Right.
But people don't have to like bankers and lawyers, but they kind of exist for a reason. If you look at the SPAC exits, the rule of thumb is that 70% of them have lost 70% of value since the IPO within 6 months of going public after that lockup period. It's horrendous. But if you take that away, how do the numbers look? I actually don't have data around it.
Yeah. Okay. So, sorry to sort of derail us on where we were, but I know that my audience finds those stories quite interesting, and thanks for explaining a bit about the IPO sort of scene. Okay, so back to where we are. So So tell us a bit about your portfolio. So because how long have you been running your network for now?
Since 2021, so we're about 4 years
Okay.
in.
Okay. Yeah. So what's the kind of, I mean, is it a fairly broad thesis? Are you pretty honed in on one particular thing? I would imagine with a group of angels that big, there's probably quite a lot of scope to cover a fair range of sectors, verticals, industries.
Yeah. So we tend to be more somewhat vertical or sector agnostic.
Okay.
There are some industries I like more than others, or there's some industries I really don't like.
Right.
Classically in venture. Yeah. So what are they?
Go on. You knew I was going to ask.
Yeah, exactly. Classically in venture, people go like, "Oh, you need a really big market." But I also look at it from a competition point of view. So, for example, let's talk about advertising and marketing tech versus sales technology. Just rule of thumb, there are 6 times as many marketing and advertising company startups versus sales technology. Right. So that speaks to like how competitive it is and why I don't like sales and marketing tech. Marketing and advertising tech, right? The other is like the buyer persona, the sale, payment cycles, all of that stuff. But level of competition is a big one for me.
Yeah, it's oversaturated for sure. Yeah.
Yeah, exactly. So we like big markets, but I don't want it to be that competitive, if that makes sense.
And especially now in the advent of AI, there's a ton of AI MarTech solutions out there that I'm seeing daily.
Correct. And investing into hot sectors or hot markets is actually something that I'm especially wary of. We're almost anti-cyclical that way, or counter-cyclical that way. Because, think about it. Anything with an AI lens, suddenly there's 5 times more companies and there's, the valuations are 5 times higher. So immediately your probability of getting a meaningful exit goes down by 25x, right? So the numbers don't work out. It's something for me.
It's funny you say that, because this is very much the reason why it's only until the last couple of years I actually decided to take the plunge on really being a founder, I guess, and being a CEO. Is because for the longest times I've always had ideas, or people have always come with me ideas. Oh, Greg, we should, join forces, become co-founders, do this. And I'd look at it and I'd go, there's money to be made, but it's just not big enough, right? The market's either too saturated or whatever it might be. It just didn't grab me. I've always sort of had this philosophy of there needs to be a market that's hidden, right? There needs to be an opportunity that no one else can see.
It's an unintuitive market.
An unintuitive market, exactly. It's like there's where we see, or I can see, there's something that no one else has really fully understood. As soon as we can see that, and we can see that the opportunity is there clearly because of a trend that is constantly going, like that I just knew in my head what these if I see that, I will get genuinely excited. That's fortunately a couple of years ago, that's what's happened, and now we are where we are with our startup. But it was very accidental.
Yes,
I knew what the parameters were, but I didn't know what it was. And then when I came across it, it's like I knew it when I saw it, kind of thing.
Exactly. And then even then, you still got a question. Am I like brilliant or just bloody foolish? There's always this.
Yeah. I believe in the fact that I'm more lucky than brilliant.
It's good to be honest. Actually, I have a question for you.
Yeah.
And you talked about people coming to you with ideas. How do you think philosophically around like, okay, do you need a co-founder, and what does it mean to have a good co-founder along that ride with you?
Yeah, I think it's really important. I mean, the thing is, I have been quite privileged as well in that for years I've surrounded myself with business owners, founders, investors, exited founders, and so on, really with the main goal of trying to absorb as much information as possible. It's like, if I can surround myself with these people, not only do I find them really genuinely interesting, which is why I do the show, like I get a kick out of having conversations with cool people and interesting people, but then I'm
sorry to bug the trend, by the way.
No, not at all. Don't put yourself down like that. Not at all. But yeah, it was kind of, but there's also the selfish reason. It's like, if you surround yourself, I don't want to be the smartest person in the room ever, right? So it's like, if I can learn from these people just in conversation, just by knowing them, just by osmosis, then I'm always going to be improving and becoming better. And that's kind of a very deep philosophy of mine, is be better than you were yesterday, always, Always strive to be a better person, a better human. Part of the side effect of that, in a very long way to answer your question, is that time and time again, I saw one of the best pieces of the common thread in that was a similar thing, which is I couldn't have done this without a co-founder, or I did this on my own. I would never do it again. My next business, I would never do on my own. I will get a co-founder. So this was a really common thread that just kept coming up and coming up. And very fortunately, that just happened organically with myself and my co-founder now, where he came to me, he was like, I've got this thing, I think there's something in it, what do you think? And then we kind of put our heads together and was like, this makes sense, we need to be co-founders, and it works. And right now I couldn't see myself doing it solo at all, because the competencies and stuff that he brings to the table, the insights he brings to the table, are so valuable, and vice versa, I hope. But more importantly, I'm a bit of a rogue, and so I can go off on some crazy ideas, and I'll come to him.
Sometimes you need a leash or like
exactly.
a sanity check.
Yeah, and he's the sensible one, so he's like, "This is cool, Greg, but we're already doing all this stuff, so maybe another day." I'm like, "Okay, all right." So,
Can I tack on to this, or like kind of argue the other side of it? I'm conflicted, right? And just full caveat, I'm like the ultimate lone wolf. Like,
right.
In a way, right? It's just a bit of my persona. Just run hard, run fast, and like, let's see how far we can go, right? I've just never been that natural personality to like that people want to support. I'm not saying that, woe is me. It's just not my character, right? I'm just, he's just going to do his thing, just like let him run with it. And kind of my tension a little bit was, I've seen, group work in the modern era in a lot of large, corporate or other social environments, in the sense that we are potentially over socialized. And what I mean by that is think about a work environment. I'm sure you've been in this, any sort of work environment, people start molding themselves to that environment a little bit too easily, right? They kind of couch what they say. They sort of mimic the agenda of the entity or whatever is kind of, topical at that point. And I've just found that a very strange part of human nature, right? At some point, if you do it too much, you lose the ability of like pure intellectual discourse and the ability to disagree, which I think is like fundamentally important. Right?
Do you mean because of a group of people essentially becomes homogenized and
correct?
Yeah.
Correct.
If you are enjoying this episode and want to support the show, please like, subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
And I'm of the view that you've got, and maybe I'm a little bit confrontational, but you got to confront things all the time, and it's healthy to disagree. It's okay, right?
100%.
We can be mates, right? We can talk about it, but it's important to be able to confront these things, right? And that's a thing that I worry about with what we build, and also kind of working with co-founders in whatever you're building, right? This is a group of peers, the dynamics shift a lot. I'm not saying, killing myself as a one-man army is the way to go. But it's hard to maintain that, just, I don't know, that ability to have conflict, to arrive at the optimal decision, and people just having disagreements, but also being supportive. It's a difficult thing.
But yeah, I mean, I would say that's entirely an experience and a personality thing, because if, as you can have founders, for example, founders and CEOs within a co-founder or senior team environment that create an atmosphere where conflict isn't, or debate, discussion, conflict, or all that isn't encouraged, which is a bad thing. I agree with you. Well, depending on how you approach it, but you absolutely need to encourage an environment where that open discourse can occur. And there are a lot of leaders, let's just say, that I would argue don't do that and don't foster the right environment to make that happen. And that's when it's bad. But if you can foster the right environment with the right amount of, just the right amount of I don't know, hubris and, removed out of the equation in the right amount. Just a safe enough space that people can feel like they can challenge you, just in the way that my co-founder does me. Like, Greg, that's a great idea, but come on, shut up. There needs to be a right amount. But then equally, if I'm putting something on the table and saying we're going to be doing this, there's also an understanding that if Greg's saying it that way, we have to take him seriously. He's onto something, So and I'm not saying I do it right 100% of the time, but I think that there is a formula that you're continuously trying to find, where you're trying to create that right atmosphere where people feel that is both encouraged, and you can challenge things and bring things to the table, but also when marching orders, let's say, for want of a better term, are given, that they also need to be followed, and that we need to believe in the vision that's kind of being laid out for us. So in that sense, I think that's why I believe so strongly in the co-founder relationship. I think that there is something about the co-founder title in a weird way, from a psychological perspective too, that, if you're working with someone senior, you both have that co-founder title. There is inherently a little bit more trust that should, in theory, come with that. A little bit of permission-based sort of nature to that allows to go, okay, well, we're both in this together. We're both building this together. Yes, the buck stops with you on these things and these things, but ultimately it allows for that conversation. I don't know if that makes sense, but I think a lot of it also just comes down to being very clear and being on the same page from the beginning. And unfortunately, I think a lot of co-founders don't do that. So they don't actually know which things maybe are within their domain and which aren't. And that's usually, I think, where a lot of unnecessary conflict and destructive conflict can occur. Is because they don't think about that. They're just so constant. They're like, oh, we'll sort it out later. So actually, it's probably worth having that discussion in the pub first. It's like, you take care of these things, I'll take care of these things. It might change, but for now, we're agreed. That often doesn't happen, and that's usually very problematic.
Yeah, that makes sense.
Yeah, but I get the appeal of being a lone ranger too. Things would certainly be easier, but we're social animals. We need that around us. I mean, you say you're a lone ranger, but you've created a network of 14,000 angels. 1,400. Sorry.
Yeah, so give me a couple of years, or we'll take it.
Well, at this rate, I'll give you a couple of months, and you'll be there. So But no, it's an interesting question. But I know it's not for everyone, and I think it really depends too on what it is you're working on, right? I mean, what we're working on is, like we said, it's quite innovative. It's new. No one's doing it. It requires a lot of expertise in a lot of different areas, and it requires all of us to making sure that there's checks and balances in all of our thinking. But I mean, if I'm just creating a Chrome extension, I want a 3-year exit. Like, I don't need co-founders, man. I don't even need a team. Like, you hear about these solopreneurs all the time. So it really depends on the project, I think.
For sure. And like you said, a character trait. Some people are just wired that way.
Absolutely. Yeah. But what were we talking about before? I can't even remember.
Exits, IPOs,
yeah, all that stuff. Well, yeah, but I mean, I think we kind of covered that. But well, look, tell me a bit about. We were talking about the thesis. That was it. Your
thesis,
the thesis, yeah. So fairly agnostic then. But there are markets that you personally don't sort of really.
There are verticals that I don't like.
Verticals, sorry, yeah.
Right.
Okay.
But generally, I'd say, look, we are B2B investors. We look at technology, we look at software. We're active in the US, Europe, and Southeast Asia, which is a very interesting perspective, because most investors don't have that broad a regional lens, a geographic lens. But we're able to do that again through our community, right? Just because people are around the world and they can just tell me more about the local markets much better than I could do myself. I think it's also a little bit by design, Greg. Early on you were talking about the VC fund and some of the constraints that they have. My whole worldview, right, just in principle, is if you want to solve a problem, you want to remove as many constraints as possible, right? But the more constraints you have, by definition, your solution set gets smaller and smaller. And I think this is one of those understated things about a VC fund, when the constraints that you operate under. Like, one is your fundraising takes a hell of a long time. You're out fundraising. Don't get me wrong. If you do it, you're sitting on dry powder to invest, but it might take you 3 years to do it. So when you enter the market is affected. right? And it does matter because if you enter the market in the wrong cycle, you might as well be done. Or you're better off returning your capital to investors before deploying it. VC funds also have a very strict mandate. They say what you can invest in, where you can do it, what stage, all of these sorts of things, right? Those things also create a lot of constraints of what are the deals you can or cannot do. And so I always wanted to broaden that within reason, of course, right? You just don't want to be completely unbridled. You want to pick your lane, stay in areas where you think you have an advantage, but also broaden it as much as possible, right? Because then, the market, the opportunity set is larger.
So what are some of the criteria that you look for as absolute non-negotiables?
We don't invest in companies that are pre-product, pre-revenue. I think as a principle, whether it's through my syndicate or personal capital, I'm philosophically, for the most part, against founders raising money before they built anything. I actually want to see enough skin in the game that you should have built a product, at least a beta, and put it out to market and show some evidence before you're asking for money. Other things that are deal breakers for me is, exploding timelines such that, I can't go through my full diligence process. Right? I'm not looking to prolong it and make it difficult, but I have a process and I will stick with it. And if the founder says, oh, we want to move fast, we're closing in 2 weeks, then it's not
Right.
a deal for us, right? I'm very happy to walk away. Something that does come up time to time and is also a deal breaker for me is, should the founders be full time? For me, categorically, I don't want founders living under duress all the time, but I do want them to have enough skin in the game, which basically means you shouldn't have a safety net in the sense of, having a job and say, I'm going to raise capital, then create the company and jump in, right? If you really have conviction in this, then go build it. Go do something, put in the sweat equity before you raise capital. Those are some parameters, right? Other than sensible things like certain revenue thresholds that we look for.
Fair enough. So that full-time thing is an interesting one because that's very common, isn't it? For people to be building something and, in fact, it's advice that I'm quite often giving to people. It's don't quit your job just yet. Like, it has to be timed very well because if you've got to pay the bills at the end of the day, you've got to live. Don't give yourself that unnecessary financial pressure. So what is a sweet spot there? Because if you can have some amazing ideas that, maybe are, deep tech or biotech or something, which, they will be pre-revenue, but they could be incredibly strong, IP with, really, really defensible IP, but they just need that capital to allow them that room to quit their job or, stop doing that part-time side gig or whatever to do it. So where's the line there? Is it just the case of, sorry, we're going to miss out on those certain deals? But it's overall a pretty defensible sort of how, yeah.
Yeah, and by the way, I don't disagree with what you're saying, right? I'm the king of the side hustles. I've always had a side hustle.
Well, it's the situation I'm in, so that's what also I'm asking selfishly for me.
Yeah, and hey, I'm a little bit paranoid, right, about having my destiny in other people's hands, to be honest, which is why I've always side hustled. It's always a way to de-risk, right? And for a long time before I started Angel School, I was like, okay, go build a product, prove that you can monetize, and to do all of these things before jumping in feet first.
Well, there's the saying about eggs and baskets, right? I mean, I firmly believe in that,
Yeah, absolutely. For where we play, B2B software technology, generally speaking, the founders should be able to build and ship product to market if they're technically competent. This is why also we choose those sectors. And I fully acknowledge, right, there's certain sectors like biotech or anything that is hardware or consumer products where it just costs too much, right, to manufacture, supply chain, inventory. And it's just not fundamentally possible. I don't know what's the answer there. Unfortunately, usually those cases, we just, I choose to opt out. But yeah, I think there are some sectors, it's not easy to generate revenue, right, until you raise capital.
Yeah, but you need to have some guardrails at the end of the day. So it makes sense. Yeah.
Yeah. Okay. I have to think about this, from a just pure investor lens. This is my hat. And founders have their own prerogatives, I guess.
Yeah. Yeah. Okay. Well, look, I want to ask about portfolio sort of the current mix, and a bit more about the education side of things. Yeah, I've got a lot of other questions, but but we've hit the end of part one. So for those listening and watching, thanks very much for listening and watching. Come back in a couple of days, check out part two, make sure to subscribe, notification bell, all that nonsense, so that you get notified when part two comes out. And that's the kind of stuff that I'm going to be asking Jed about. So thank you, Jed. And that's end of part one, everyone.
Thank you for listening and or watching. Subscribe with notifications turned on to get notified when part two comes out. While you wait, please join in the conversation in the comments below.